US and Japan coordinated to help stabilize the yen. That's the headline from the New York Times, reporting that the Treasury Department moved last week to prop up a currency that had been trading near 4-decade lows. The operation marks the first joint foreign exchange intervention between the two nations in more than a decade. President Trump confirmed on Sunday that the Treasury had assisted Japanese authorities, and Japan's finance minister, Satsuki Katayama, said the step was taken to counter what she called excessive volatility and disorderly movements in the yen after months of sustained weakness. The yen has been sliding steadily against the dollar this year. Investors have grown increasingly worried about Japan's expanding fiscal spending, a concern amplified by higher energy costs that stem from the U.S. war with Iran. In July, the currency fell to its weakest level since the early 1980s, with the dollar briefly climbing above 163 yen, up from roughly 147 yen a year earlier. The Financial Times, citing sources, reported that the United States sold euros to buy yen, a move that helped strengthen the Japanese currency. In Tokyo trading on Monday, the yen surged to around 155 per dollar before settling near 156.50. The intervention underscores the delicate balance surrounding the dollar's global role. President Trump has repeatedly argued that an overly strong dollar hurts American exporters by making U.S. goods more expensive abroad. At the same time, Washington has a strong interest in preserving the dollar's position as the world's dominant reserve currency, the benchmark that businesses, banks, and people use to price goods and settle accounts. Analysts note that the joint action also signals a willingness by both capitals to manage exchange rate tensions without resorting to unilateral measures. The move comes as global markets watch for any shift in the Federal Reserve's stance on interest rates. For Japan, a weak yen produces mixed results. On one hand, it improves the competitiveness of Japanese exporters, on the other, it raises the cost of imports, especially energy. Because oil is typically priced in dollars, Japan faces a double burden of higher global oil prices and a weaker currency, forcing importers to spend more yen for every barrel. The yen's decline mirrors broader weakness across several Asian currencies as the dollar has strengthened. Since April, Japan's finance ministry has spent tens of billions of dollars purchasing yen to prop up the currency, with limited success. Speaking in Tokyo on Monday, Minister Katayama said the government believes the yen is undervalued, pointing to Prime Minister Sanai Takaichi's efforts to revive the economy. The coordinated move coincided with the Bank of Japan's latest policy meeting, where officials left interest rates unchanged but signaled that additional rate increases remain possible. That's the latest on the joint US-Japan effort to steady the yen. Thanks for listening, and we'll be back soon with more analysis.